One of the best investors we know in the United States is Warren Buffett. So I want to touch basically on what he does, how he does it, and so you can learn how to be a better investor. I want to talk about Warren Buffett and what does he look for in a company and the timeless principles behind his investments. So what he does is he focuses on understandable businesses. He invests in businesses he can understand, looks for clear, simple business models and consistent demand, avoids businesses that are too complex or hard to predict. So in this slide, I want to talk about the competitive advantage or the economic moat that brands that he looks for. In this case, Coca-Cola. This slide will present some of those characteristics. He also looks for companies like Coca-Cola, for example, that have competitive advantage or economic moat, if you will. Buffett looks for companies that are hard to beat. They have a strong brand, customers trust the brand and keep coming back, loyal customers, people prefer the product and don't want to switch, low costs, the company can make and sell products cheaper than others, unique advantage, something competitors can't easily copy or replicate, can keep winning for years. The business stays strong and keeps growing over the long term. Key takeaway: buy companies that will be still leaders in 10 to 20 years from now. We want to own wonderful companies. Warren Buffett. He also looks for excellent management. Seek honest, capable, and rational leaders. Management should think like owners, not empire builders. A great company with integrity is critical for long-term success. Financial strength. What does Buffett look for in a balance sheet? Why he looks here. A strong balance sheet shows a company can handle problems, invest in growth, and keep compounding value for years. Low debt. Little to no long-term debt. Why? Less risk and more flexibility. Strong interest coverage. The company makes more money than it pays in interest. Why? It can easily pay interest and even in bad times. ROE, return on equity. ROE is consistently above 15 to 20%. Why? Shows the business earns well on shareholder money. Consistent equity growth. Shareholders' equity grows steadily over time. Why? Retained earnings are building value. Large cash position. Plenty of cash or short-term investment. Why? Provides a cushion and opportunities. Good liabilities versus assets. Current assets should be greater than current liabilities. Why? Can meet short-term obligations easily. Buffett wants financially strong companies that can survive tough times and keep growing value over the long run. He also looks for ROE, look deeper dive for the ROE, high return on equity. Buffett looks for businesses that generate consistently high returns on shareholder equity. For example, here on Apple, why it matters, shows management efficiency, indicates competitive advantage, creates long-term compounding, leads to higher intrinsic value. Buffett wants to see ROE consistently over 15% for many years. Consistent earnings growth. Buffett loves businesses with long track records of steady, predictable earnings growth. Long history, over 10 years of earnings growth, recession resilience, low earnings or volatility, strong demand for products and services. So in this next series of slides, I want to show three main components that the financial statement will show you. One is the income statement, second is the balance sheet, and the third is the cash flow statement. After this slide, I'll have additional slides that have a deep dive into each one. Next, I want to talk about financial statements like a masterclass. Buffett reads the numbers to understand the business. He looks at income statements, balance sheets, and cash flow statements. Income statements, he looks at revenue growth, gross margin, operating margin, net margin, earnings consistency. Balance sheets, he looks at low debt, high interest coverage, strong current ratio, growing book value, share repurchases. Cash flow statements, he's looking for operating cash flow, free cash flow, capital expenditures, cash conversion, and owner earnings. Buffett doesn't look at the numbers, he looks at trends, quality, and consistency. So balance sheet strength. Buffett looks for financial strength and flexibility. So he looks for low debt, prefers little to no debt. Strong balance sheet equals survival and opportunities. Strong interest coverage. Operating income, Interest expense should be high. Large cash position provides a cushion in tough times and optionality for opportunities. Growing book value shows value is being created for shareholders. Share repurchases. Buffett loves buybacks when done below intrinsic value. Look for a company with strong balance sheet because sooner or later you're going to need it. Let's get into the details. Here's reading a income statement. You can pause the video and look at this closer. Ideally, he's looking at number one, revenue. Is it growing consistently? Two, gross margin. What's left after producing the product? Three, operating income, true profit from business. Net income, number four, bottom line profit available to shareholders. His focus, consistent revenue, high gross margin, strong operating income, and rising net income over many years. Next, reading a balance sheet. Look for financial strength and flexibility. So cash investments provides a cushion and optionality in opportunities and downturns. Debt. Buffett prefers little to no debt. Lower is better. Shareholder equity. The true net worth of the business should grow steadily. And what's he focusing on? Strong balance sheet, high cash flow, low debt, and growing shareholder equity. Reading the cash flow statement. Cash is fuel of the business. Operating cash flow, the most important, shows cash generated from the core business. Capital expenditures, CapEx, money spent to maintain and grow the business. This pertains to AI companies right now, but as we discussed on Saturday 7/18 video, what's happening is, are expectations going to be a reality or not? Free cash flow, operating cash flow minus CapEx, cash available to owners. Warren Buffett's focus, strong and growing operating cash flow and free cash flow. 10-year trend analysis. 1 year means little. 10 years tells the truth. Here is, for example, an example of the ROE percentage, the revenue in billions, earnings per share, free cash flow. Buffett wants to see long-term consistency, growth, and resilience through different economic cycles, especially if there is a recession. How did you manage that as a company to make it weather yourself through the storm? Warren Buffett also looks for attractive price, value plus margin of safety. Buffett doesn't pay fair value prices. He looks for great businesses at a great price that gives him room for error. So he looks for value, not just quality. A wonderful company can still be a poor investment if the price is too high. He compares price to the business's intrinsic value, what it's really worth. Two, he buys below intrinsic value. Buffett wants to buy at a discount, typically 20 to 30% below intrinsic value, possibly during a recession or a major pullback. This margin of safety protects against mistakes and unexpected problems. Be greedy when others are fearful. He looks for opportunities when good companies are unpopular and out of favor. Fear causes prices to fall, creating the best buying opportunities. How he judges if the price is attractive. Price to earnings, lower PE than the company normally range and their peers. Price to book, looks for solid businesses trading at reasonable multiples. Free cash flow yield, prefers companies that generate strong cash flow for the price he pays. Margin of safety, buys at a price that he leaves a cushion that things don't go as expected, if things don't go as expected. So key questions Buffett asks, am I paying less than the business is worth? Possibly during recession, you get a discount, a sale price. Is there a margin of safety if I'm wrong? Would I still buy if the market stayed pessimistic, especially during a recession? In this slide, I want to show specific examples. In this particular case, it's Apple. So in this particular slide, I want to show of what he did and how he did it for Apple. Here's some examples. Apple, Buffett saw a dominant brand, loyal customers, huge cash flow, and a stock trading below its long-term value. He bought in approximately 2016, about $96 to $105 a share, bought them and then sold it in 2018 around $175 plus for a great gain. So rationale, massive cash pile and free cash flow, strong brand ecosystem lock-in, trading around 9 to 10 times earnings at the time, high return on equity, above 30%. The result, Apple has been one of Berkshire Hathaway's largest winners. The stock has multiplied several times since Buffett first bought it. Next is Bank of America. So what he did here is purchased in 2011, 2012, right after the financial crisis hit, saw the opportunity, waited for the prices to fall. And I'll talk about that later in terms of looking at the market during this period of time, started buying. And then also from 2012 to 2014, he made approximately from the stock was around $5 to $8 and it went up to about $16 a share. So a 2x return. So, simplified rationale. Great bank with a strong brand, very cheap price. Problems were temporary. Buffett believed it would recover and be much more valuable later. The result made billions of dollars for Berkshire. The stock price returned to normal levels over time and one of Berkshire's most profitable investments. Key takeaway: Buffett buys great businesses while others are fearful and the price is low. Some examples of great businesses that fit Buffett's criteria today. I think that's most pertinent to most people, right? So the quality businesses plus strong financials plus attractive prices. Apple, why does it fit? Strong brand, loyal customers, high profit margins, huge free cash flow, very strong balance sheet, consistent return on equity. Its moat, it has its own ecosystem, brand, and switching cost. If I want to go to something else, then it's going to be more difficult. Coca-Cola, why it fits. Iconic brand with global reach, low cost to produce, high margins. It's low cost to produce and it has high margins. People buy in good times and bad times, consistent dividends for decades, strong balance sheet, its moat, it's its brand, distribution network, and scale. AXP, American Express, why it fits. Premium brand and loyal customers, high return on equity, above 20%, wide economic moat, that network effect, excellent management, strong balance sheet, its moat, network, brand, customer loyalty. Moody's, why it fits. Dominant in credit ratings data, high margins and cash flow, very little debt, recurring revenue model, high return on equity, its moat, data, reputation, switching costs. Buffett looks for wonderful businesses with strong moats, solid financials, and a price well below intrinsic value. He is patient and buys when others are fearful. Be fearful when others are greedy and greedy when others are fearful. So I have two lists here. Buffett has a 60-second stock test. Can I answer yes to all 10? One, I understand the business. It has a durable competitive moat. Revenues grow consistently. Earnings grow consistently. ROE is above 15%. Free cash flow is increasing. Debt is low. Management allocates capital wisely. Shares trade below intrinsic value. I'd happily own it for 10 years. If you could answer yes to all 10, that would be great. Not all companies meet all 10 criteria, but the larger the number, the better. Here is one more checklist with a couple more variables in it. If you can pause the video and watch this at your leisure. I want to discuss here, if we look at history, it's amazing how much you can learn. So here's the SPY from 1996 to 2010. And you can see the support and resistance levels, support being on the bottom, resistance up being on top. As the price action hits the resistance, watch one's position, potentially getting out. And sure enough, you see that the price action went up. As soon as it hits the previous support on the left of the screen, there are additional indications where the support should be. As you mark your charts for support, as the price action hits support, watch one's position potentially getting in. So you have a a resistance level as the price action cuts through the resistance becomes support. That's when you should get in. You ride this wave. Now it hits the price action hit its head on resistance and started going down. So ideally you could cut your position size or get out of the trade altogether. If you did that, now you can switch strategies and make money as it goes down. You get in again in the long buy position as it hits support and starts going up with confirmation, creating the lower, the higher lows and the lower lows have stopped. Now you're getting higher highs and higher lows, indicating a new trend has started. You ride this wave, and again, we see it hits resistance, starts going down, the potential to get out slowly and then ultimately scale out of the position, change strategies, make money as the stock falls, the SPY falls, and then again we hit resistance again. And we get into the trade. So you bought, you ride the wave, you see that it's falling, you get out, switch strategies, make money as it goes down, buy again, and ride the wave and repeat. Now, this is important. A lot of people have not, if you were trying to retire during this period of time, look at what a roller coaster 1996 to 2010 is. It was just unbearable where you made money. If you didn't get out, this whole long-term hold nonsense, I totally disagree with. And this is exactly why. What happened is that if you had to retire in 1997 and you had a long-term hold, you made money, then you lost all the money and just broke even, then you had the same cycle again. I disagree with a long-term hold. I think you should go in, make your money, switch strategies, and make money as the market's going up or down regardless. If you don't know this strategy, I teach it in my upper tier course on Patreon, and I'm working on a website. So another if you don't want to do that, here's another option: getting in, riding the wave, if you will, and then possibly here getting out, sitting out of the market until you see new opportunity. That's another way of doing this. Now, for example, we just talked about 1996 to about 2000, and let me look back just for a second. Sorry, this was about 2010. So 2010 would be right around here. So what you're doing here is you rode this wave up, you either switched strategies or you got out of the market and repeated. You can see here where you can buy your position. If you use just a Darvis box, as we discussed before, as soon as the price action breaks above the Darvis box, one, you were out and now you're in again. And same thing here with the Jarvis box concept: out and then in, and now you're riding this wave. Now you're looking for the next opportunity. When can I add to my position size? Once the price action broke from above through resistance, the resistance became support. That's a confirmation to add to your position size. So you can add more here. Now you're hitting a new resistance level. You can take some off, lock in some profits. Now all of a sudden the price action broke through the resistance, became support, and now you're riding the next wave. So you had a nice, beautiful run here of when to buy, when to get out to make money in this market. And you can see since then the market has been rising. But if you had to retire around this period of time, you really need to, no one's going to call you and tell you unless you watch someone like me or other active, experienced traders. No one's going to call you and say, around this period of time, you should be cognizant that you need to get out or minimize your position size or get out or switch strategies. If you don't know, get a mentor, because the impact on your 401k is going to be gigantic, especially as you approach retirement. So again, locking in profits near the point of resistance and then adding to your position size as you bypass, as the price action cuts through the support, cuts through resistance and goes through support and starts rising, and locking up profits in along the way. That's how you should trade. So Buffett's investing process: a simple but powerful framework. Understand the business. What does the company do? How does it make money? Evaluate the moat. Does it have a sustainable competitive advantage? Analyze its financials. We discussed the balance sheet, high returns, and consistent cash flows. Assess the management. It should be honest, capable, and shareholder oriented. Determine its intrinsic value. What is the business really worth? Enter a margin of safety. Buy at a significant discount to intrinsic value. Ideally, wait for a drop in the market. Ideally, a major pullback, at least 20, 30%, or during a recession. Um, get in. Buy with conviction when all the boxes are checked. Hold for long term. Let time and compounding do the work. Again, from the last slide I showed you, I kind of disagree with this. If you're younger, yes. If you're older, try to lock in profits while you can and don't give back the market all your gains. Review and be patient. Ignore noise, let fundamentals win. Our investing philosophy is very simple. Try to be fearful when others are greedy and hungry when others are fearful. Checklist, just slightly different way. Understand the business. Do I understand how this business makes money? Two, competitive advantage and moat. Does the company have a sustainable moat? Quality management. Is the management honest, capable, and the shareholders oriented? Financial strength, strong balance sheet, consistent earnings, and cash flow. And we talked about those. Intrinsic value, what is the business really worth? Margin of safety, is the price significantly below intrinsic value? Buy or wait. Does it meet all the criteria with a margin of safety? If not, wait. The best businesses, plus the right price, plus patience, you have extraordinary returns. So I've talked a lot about Warren Buffett and some of the principles and some of the details that he's mentioned. If you want to take a deeper dive, here are some of the books associated with Warren Buffett and some must-read sources if you want to learn more. And I highly recommend always digging deeper, always learning more. Understand in these books you'll find charts, you'll find additional details. It's always better to dig and learn as much as possible, and then you have that knowledge at your fingertips and your arsenal. The more you learn, the more you earn. So businesses Buffett avoids. If it doesn't fit if it doesn't fit his circle of competence, he passes. Commodity business, low margins, high competition, no pricing power. Airlines, historically, he doesn't invest in them. High capital needs, volatile earnings, intense competition, turnaround stories. Trying to fix broken companies is not his game. Businesses he doesn't understand. If he can't explain it simply, he won't invest. Companies with no moat, easily copied, easily competed away, he doesn't touch those. Buffett would rather miss an opportunity than make a mistake. Red flags. Too much debt, high leverage increases risk. Falling ROE, returns declining year after year. Accounting gimmicks, aggressive assumptions hide the truth. Constant share dilution, existing shareholders get diluted over time. Weak cash flow, earnings without cash does not pay the bills. CEO over promising. Big promises today often disappoint tomorrow. Avoiding avoiding bad investments is just as important as finding great ones. If you like this presentation, please like and subscribe. If I added some value to your day today, please like and subscribe. If you want a deeper dive in terms of more concepts, I offer that in my Patreon page and my Premier tier. I answer all these questions on the left, and also any questions you can have, we can walk through so you have a better trader. I find that if you ask questions and I can answer them immediately, you feel more confident and your questions are answered and you can move forward with confidence.